Welcome. Let me ask you something. Have you ever had a year where your business or your investments just didn't pan out, and you wondered if there was any silver lining at all? Well, in the world of Canadian taxes, there just might be. Today, we're going to demystify a really powerful tool called loss carryovers. Now, the rules can get a little tricky, but trust me, understanding them can make a huge difference to your bottom line. So let's break it all down. Before we jump in, just a quick note. This explainer is built on the core principles of Canada's Income Tax Act, and the goal here is to give you a clear, straightforward overview of how these important rules actually work. All right, so let's kick things off with the big question right here on the screen. Could a financial loss in one year actually reduce your taxes in another year? I mean, it almost sounds too good to be true, doesn't it? But the answer is a resounding yes. And how that works is exactly what we're going to unpack today. So here's our game plan. First up, we'll lay the groundwork by looking at how taxable income is calculated. Then we'll dive into the critical differences between capital and non-capital losses. We've also got a really interesting special case to talk about called ABILs. After that, we'll get into the mechanics of applying these losses. And we'll finish up with some key strategies and, just as importantly, some common pitfalls you'll want to avoid. All right, let's get started. Section 1, calculating taxable income. You see, before we can even begin to talk about using losses from other years, we have to understand exactly where they fit into the whole tax calculation puzzle. This really is the foundation for everything else we're going to talk about. Now, this is a really crucial distinction that a lot of people miss. Net income is not the same thing as taxable income. Think of net income as the first step. It's pretty much all your income from every source added together. But, and this is a big but, you don't pay tax on that entire amount. You first get to subtract a special group of deductions, and it's in that group where these loss carryovers live. It's a pretty straightforward process, but it's incredibly powerful. You start with your net income. Step 2, you subtract those very specific Division C deductions, which is exactly where you claim your loss carryovers. And what you're left with is your taxable income. That final number is the one that the tax rates get applied to, which is why making that number smaller with these deductions is so valuable. Okay, so we've got the where figured out. We know where these losses get deducted. Now let's talk about the what. What kinds of losses are we actually dealing with? There are two main categories, and understanding the difference between them is absolutely critical. Okay, this is really the heart of the matter. If you take one thing away, it's this. The fundamental difference is flexibility. Look at non-capital losses. They come from your business, your property, your employment, and they are incredibly versatile. You can use them to reduce your tax on any kind of income. Capital losses, on the other hand, which come from selling investments, well, they're much more restricted. They're walled off in their own little world. Let's put some real numbers to this. It makes it so much clearer. So imagine a freelance consultant. She has a pretty good year, brings in $60,000 in revenue. But her business expenses, things like marketing, rent, supplies, they add up to $75,000. That gap creates a $15,000 non-capital loss. Now, that 15 grand isn't just a number on a page. It becomes this incredible tool in her tax toolkit. She has two main options. She can carry it back up to 3 years to apply it against profit she made in the past, which would trigger a nice tax refund. Or she can carry it forward for up to 20 years to reduce her taxes in future, more profitable years. Lots of flexibility. Okay, now let's pivot to the other side of the coin. Let's look at an investor. Let's say they sell some shares and take a $20,000 loss. Bummer. But in that same year, another stock does well and they sell it for a $12,000 gain. For tax purposes, you first net those out, which leaves them with a net capital loss of $8,000 for the year. And here is the absolute key takeaway. That $8,000 loss, it's basically locked in a box. The investor can't use it to lower the taxes they owe on their salary or any business income. It can only be used to cancel out taxable capital gains, either from the last 3 years or at any point in the future. It's in its own lane. So we've got these two very distinct worlds, right? The flexible, non-capital world and the restricted capital world. And normally they don't mix, except when they do. Let's talk about a very special hybrid case that sort of breaks the rules. It's called an Allowable Business Investment Loss, or an ABL for short. You might be wondering, why does this special rule even exist? Well, it's all about policy. The government wants to encourage people like you and me to invest our money in Canadian small businesses. So, to sweeten the deal and reduce the risk, they've created this preferential tax treatment for when those investments don't work out. And that is the superpower of an ABI. It starts its life as a capital investment. You're buying shares or loaning money to a small business. But if it goes south, the loss you get is treated like a super flexible, non-capital loss. You can use it to offset any income you have right away. But like a lot of good things in tax law, there's a catch. There's a time limit on the special treatment. As you can see in the table, for losses happening in recent years, you get a 10-year window to use that ABIL against any source of income. If, after a decade, you still haven't used it all up, it doesn't just disappear. Instead, it transforms. It reverts back to being a standard net capital loss, which you can then carry forward indefinitely against future capital gains. All right, we've covered the what, the different types of losses. Now it's time to get into the nitty-gritty, the how. How do you actually apply these things? The mechanics and the timing are super important. I love this timeline because it perfectly illustrates the entire lifespan of a non-capital loss. It all starts in year 0. That's the year you actually incur the loss. From that point, you have a choice. You can look backwards up to 3 years and file a special form to get a refund on taxes you've already paid. Or you can look forward and carry that loss for up to 20 years to use on your future tax returns. That's a massive 23-year window, which gives you incredible room for strategic planning. Okay, lean in for this one because this is a mistake I see people make all the time, especially at year-end. You might think that selling a stock on December 31st means you can claim the loss for that tax year. Not necessarily. The stock market has a settlement period, usually 2 business days after the trade. For the loss to count, the trade has to settle by year-end, which means you actually need to place your sell order a few days before December 31st. It's a classic gotcha. Okay, let's pull all of this together in our final section. Now that we know the rules, let's talk about how to use them strategically. We'll look at one of the most common strategies out there and also a couple of critical pitfalls the government has put in place that you really need to watch out for. So let's talk about a really common and smart strategy called tax loss harvesting. You see it a lot in late December. The idea is simple. Say you've sold one investment for a big gain. You look at your portfolio and see another investment that's currently sitting at a loss. You can strategically sell that loser to harvest the loss. That capital loss then cancels out your capital gain, and poof, your tax bill gets smaller or might even disappear entirely. But, and this is a huge but, the government isn't naive. They know about this strategy, so they created something called the superficial loss rule to stop people from gaming the system. You can't just sell a stock on Monday to claim the loss and then buy it right back on Tuesday. The rule basically says if you or someone close to you buys back the same property within a 30-day window before or after the sale, your loss will be denied. And just to round things out, it's really important to know that not every financial loss you experience in life is a tax loss. The rules are quite specific. For example, if you have a business that's really just a hobby that consistently loses money with no real profit motive, you can't deduct those losses. And another big one, you can't trigger a capital loss by selling an investment to your own RRSP or TFSA. That's a definite no-go. Wow, okay, so we've covered a ton of ground here. We started with the basics of taxable income, we dove deep into the 2 different worlds of capital and non-capital losses, and we even looked at special cases and strategies. The big takeaway is that these rules aren't just for accountants to worry about. They are active, powerful tools for your personal financial toolkit. So I'll leave you with the question on the screen. Now that you understand this framework, which of these tools could you use to reshape your financial strategy?